Imagine this. You are renewing your car insurance online. The form takes 5 minutes. The price looks reasonable. You recognize the brand. You click confirm and move on with your day, confident you made a responsible decision. That moment feels neutral, even boring. But that is exactly why the car insurance trap works so well. Car insurance is not designed to be examined closely. It is designed to be accepted. It presents itself as protection, responsibility, and compliance all at once. You are not encouraged to question it, analyze it, or truly understand it. You are encouraged to have it, and that distinction matters more than most people realize. My name is Arlo, and on this channel we examine how everyday financial systems quietly shape behavior, decisions, and outcomes in ways most people never stop to question. If you find this analysis useful, consider liking the video and subscribing, not for entertainment, but so these discussions are easier to find when you need them. The common belief is simple. Car insurance exists to protect you from financial harm. You pay a premium, and in exchange, risk is transferred away from you. That belief feels intuitive, which is why it goes largely unchallenged. But the reality is more complicated. Insurance does not eliminate risk. It redistributes it selectively, under conditions that strongly favor the insurer. The first misconception is that coverage equals safety. In practice, coverage is conditional, limited, and structured around exclusions. Deductibles, depreciation, coverage caps, and claim discretion all exist to ensure the insurer's exposure remains controlled. You are not buying certainty. You are buying partial relief, framed as total protection. Language plays a major role here. Terms like full coverage imply completeness, yet they have no standardized definition. What most people call full coverage simply satisfies lender requirements. It does not guarantee that your losses will be fully reimbursed, your time will be respected, or your inconvenience will be minimized. The label creates comfort, not clarity. Another layer of the trap is personalization. Insurance companies emphasize risk-based pricing as fairness. In reality, personalization allows insurers to charge each customer the maximum amount they are willing to tolerate without leaving. Your driving data, credit profile, location, and behavioral signals are used to optimize pricing, not generosity. This creates an illusion of control. Drivers believe safe behavior guarantees lower costs. Sometimes it does, often it does not. Premiums rise due to regional claims, litigation trends, healthcare costs, or corporate profit targets. When prices increase without obvious cause, most people assume it is unavoidable. That assumption discourages resistance. The true test of insurance is the claim, and this is where expectations and reality diverge sharply. Claims are not collaborative processes. They are negotiations conducted under asymmetric power. The insurer controls the timeline, the valuation method, and the interpretation of policy language. You are expected to comply while remaining patient. Depreciation quietly erodes outcomes. Most policies pay actual cash value, not replacement cost. That means your payout reflects a calculated market value, not the cost to restore your previous standard of living. The gap comes out of your pocket. This is not a failure of the system. It is the system working as designed. So why do intelligent, financially responsible people accept this without question? Because car insurance activates responsibility bias. Being insured feels like being an adult, prudent and compliant. Questioning the structure feels unnecessary or even reckless. Once framed as a moral obligation, analysis shuts down. Authority bias reinforces this. Insurance contracts are dense, regulated, and technical. People assume oversight implies fairness, but regulation sets minimum standards, not optimal consumer outcomes. Complexity protects margins. When something feels too complex to challenge, most people default to trust.
Loss aversion is the final lever. The fear of catastrophic loss pushes people to over-insure against rare events while underthinking common, manageable ones. Insurers highlight worst-case scenarios while pricing everyday inefficiencies into premiums. Emotion overrides probability, and cost efficiency collapses. What most people misunderstand is the nature of risk transfer. Insurance only covers specific losses under specific conditions. Everything else remains yours. Yet most drivers never read exclusions or reevaluate coverage as their car depreciates. The policy stays the same while reality changes. There is also the loyalty illusion. Long-term customers often pay more than new ones. Inertia is profitable. Automatic renewals and small annual increases condition acceptance. Loyalty feels rewarded, but it is frequently penalized. Over time, the mismatch compounds quietly. The car insurance trap is not about fraud or deception. It is about incentives and psychology. Insurers optimize continuously. Consumers engage passively. Where those forces meet, value leaks away. The goal is not to eliminate insurance. The goal is to stop treating it as a moral checkbox and start treating it as a strategic tool. That requires reframing what protection actually means, where it ends, and how your behavior is subtly guided. The next step is to move from awareness to clarity, because understanding the structure of car insurance matters more than emotional reactions to it. Insurance is not a relationship, a promise, or a moral safeguard. It is a financial contract designed around boundaries. Once you accept that framing, the confusion starts to disappear. Every insurance policy defines limits first and protection second. Deductibles exist to ensure that you absorb frequent, manageable losses yourself. Premiums exist to create predictable revenue for the insurer. Coverage caps exist to control exposure. None of these features are accidental. They are carefully calibrated to make insurance profitable even when claims occur. Deductibles are the most misunderstood component. Many drivers choose low deductibles because they feel safer. In reality, low deductibles trade long-term certainty for short-term comfort. Over years of driving, the extra premiums paid often exceed the value of the occasional reduced out-of-pocket cost. The math favors insurers because the decision is driven by anxiety rather than probability. Liability coverage creates a similar illusion. Higher limits feel responsible, but responsibility is rarely defined clearly. Most people never calculate the actual assets that could realistically be at risk in a lawsuit. They select round numbers that feel prudent without understanding exposure. This disconnect allows fear to replace analysis. Collision and comprehensive coverage reveal the same pattern. As vehicles depreciate, the expected payout shrinks. Premiums, however, often remain stable or rise. Many drivers continue paying for coverage that no longer makes financial sense simply because they've always had it. Inertia replaces intention. Claim behavior adds another layer. Insurance pricing assumes that most people avoid filing small claims. When claims occur, future premiums often adjust quietly. The system discourages use while advertising availability. Insurance functions best when reserved for losses that would meaningfully disrupt financial stability, not minor inconveniences. This leads to a useful mental model. Insurance should be treated as a financial firewall, not a convenience fund. It exists to prevent catastrophic damage, not to manage everyday friction. When insurance is used to manage minor losses, costs increase without improving outcomes. Rate shopping exposes another hidden reality. Long-term customers are often the most profitable. Loyalty is rarely rewarded. Automatic renewals, modest increases, and complexity create passive acceptance. Comparing rates regularly is not disloyalty. It is rational participation in a competitive market. Administrative friction is an overlooked cost. claims require documentation, negotiation, and patience. Time and attention are consumed. Stress increases. These costs are rarely included when people evaluate insurance value, yet they matter. A system that creates friction discourages frequent use by design. Behavioral feedback loops also shape outcomes. Knowing losses are partially covered can subtly reduce caution. This is not reckless behavior. It is marginal, slightly less vigilance, slightly higher tolerance for risk. Over time, these small changes accumulate. Technology intensifies this dynamic. Usage-based insurance promises savings through monitoring. For some drivers, it works. For others, it introduces volatility and surveillance without meaningful benefit. The data almost always improves pricing precision for insurers. Whether it improves value for the driver depends on discipline and transparency.
The broader truth is not that insurance is deceptive, but that it is optimized. Optimized systems extract value from passivity. The trap is not buying insurance. The trap is assuming the purchase completes responsibility. A more effective approach is periodic reassessment. Coverage should change as circumstances change. Deductibles should align with savings. Liability should reflect actual exposure. These adjustments are rarely dramatic, but they prevent slow financial leakage. The most important shift is psychological. Insurance does not make you safe. It limits downside under specific conditions. When expectations are realistic, disappointment decreases and overpayment becomes visible. Financial systems often persist by encouraging shallow understanding. Car insurance blends necessity with obscurity. Once people feel informed enough, they stop asking questions. That moment is profitable. Understanding the car insurance trap does not require rejection. It requires deliberate engagement. Awareness replaces trust. Analysis replaces habit. Responsibility is not measured by how much coverage you buy. It is measured by how well you understand what coverage does and does not do. When that distinction becomes clear, insurance stops feeling like protection and starts functioning as a boundary around risk. This mindset applies beyond cars. It applies to every financial product sold primarily as reassurance. When comfort is the selling point, inefficiency usually follows. Car insurance is one of the first places most adults encounter this pattern, which is why it matters. Applying investment-level scrutiny to insurance decisions exposes inefficiencies. Premium drift becomes noticeable. Coverage mismatches stand out. Emotional decisions lose influence. The final mental model is simple. Insurance should protect your balance sheet, not manage your emotions. When it starts doing the latter, cost efficiency collapses. Clarity does not remove uncertainty, but it restores agency, and agency is something no policy can provide. That distinction quietly separates informed participants from passive consumers.